You know, you're for master data in the general ledger area, the master data is the chart of accounts. Master data for the customer side is the customer accounts. Master data for the vendor side is the vendor accounts. Right? So you're going to have configuration focused on how you create the master data and controlling how the master data is created. Right? So that's one. The next section of it is going to be how you record transactions against that master data. That'll be the next one. Creating the master data. How do you control it? How do you manage it? The next piece is transactions. How do you control how transactions enter into that master data? Right? And the same thing is okay. And then the next one is how you control getting it out of the master data, or reporting of it. So what I mean coming out of it, it's sorting, how you sort it, how you report off of it, how do you lay out, what kind of layouts, what kind of extra fields you would have so you can report on it. So correspondence and those kind of things. So it's really aimed at creating the master data, uh, how data gets into the record, you control it, how data gets updated, and you control it, how data comes off of it. Really, can you think of any other, which is coming out of it is how you report on it and how it passes on to the other ones, right? So you'll see in the general ledger piece, a lot of that you just talked about was how do you control creating the master data. So how do you control creating the chart account? What groupings do you do? You see the account groups. What groupings are you going to have? And what the number ranges you're going to assign to each group. You know what I mean? And so you're going to say, okay, well, I want, assets, the fixed assets to be this group and this number range and all of that. Here's the chart. Here's how it's going to be. It's a centralized chart. This is how you assign it to the chart. This is how you assign it to the company. And these are the number ranges for cash. These are the number ranges for assets. And these are the posting keys and the field status groups. You know what I mean? When you set up the master data. So now when you set up that master data, you'll see all of that piece. You can say, from what I saw, a lot of the transactions was how you control creating the master data. Right? You'll see. If you go back, it says, okay, here is the account groups. Here's the number range for the account groups. And so on and so forth. Here's a retained earnings account. Those kinds of things. Now, when you look at master data, then the master data can actually, so you've got the master data established. Master data is going to control how the transactions, how you enter data on it. So first thing, if you get the master data squared away, then you're controlling how people interact with the master data. So one of the key points is okay, posting keys you saw. Posting keys on general, so you go in there and say, it's okay. Posting keys is kind of global, right? You have posting keys for customers, posting keys for vendors, posting keys for general ledger. Hmm? It's a config point, but it's a config point that says this is how you have to get records on the master data using these posting keys. So the purpose of it is not the master data, but the purpose of it is how do you get data onto the record, whether it's a customer, whether it's a vendor. You do that also with the field status groups. So the field status groups purpose is how do you, I'm going to force you to put certain things on a general ledger. What can you see the purpose? You see the purpose of it. It's okay. Uh, each group that you set up for the ledger, each group that you set to the ledger has certain characteristics like cash, accounts receivables, prepayments, fixed assets, long-term assets, liabilities, short-term, long-term, equity, profit, revenue, expenses, so on and so forth. Now, those are some of those account groups that you set up. Now, within those account groups, you want to capture, because each one of them, you want certain attributes on each one of them that it's relevant for that particular account. Like a cash account, the things that you want to make sure you get captured on a cash account is not necessarily the same thing you want to capture on a prepaid account. So it's certain things that are important for me to capture on a cash account may not be important for me to capture on a long-term liability. So that's why you got the buckets so that you can make sure you put them in a field status which says, okay, this group I want to capture, a sort key. I want to capture a allocation key. I want to make sure you put the right currency on it. I want to make sure you put some text on it. I want to make sure you have the customer on it, so on and certain things. So you're going to force the user to put the necessary data on the record that is required for the transaction so that you can get it out, right? So if you don't put it in, you can't get it out, right? So that group of config is, and you can probably go through and say, okay, that group of config is managing how someone enter records and controlling that. And then the next piece of group is going to be controlling how data is getting out. And you only got three types of data. You only got three types of data in the whole system, and that's configuration data, master data, and transactional data. It's just so it has to fit within one of those buckets. Is it transactional data? Is it master data? Or is it config data? So, like if you go through the GL again in that PowerPoint presentation, can you see? Yeah, go through it. Can you see which one is of the three: master, transaction, or reporting?
Okay. This will definitely be master data.
Mm-hmm.
This is master data. This is master data as well.
Mm-hmm.
Groups. Maybe configuration data? No?
Yeah. Yeah. So
Because we're configuring the account numbers?
Yeah. So you got three types. The type of data it is, but what is it controlling? Two separate questions. This data is configuration data. Controlling master data. Yeah. Mm-hmm. For general ledgers, yeah. You have that same situation for AR and AP.
Mm-hmm.
The same concept of a group. So you can see a person would want to know something different about fixed assets compared to liquid funds or material management accounts. They have the characteristics are different. I want inventory, so this is going to be inventory related guys. This is going to be AR related guys, and I'd have cash and some other type of things. You know what I mean? So that you can make sure that the attributes on that particular guy is on. So now that's master data. But this is configuration data, but it's controlling master data. Right. So you keep going. Master data. No, this is actually the physical master data itself. This is actually when you're creating the master data. You set it up, and it just so happened to be this transaction is in the configuration menu, but it's really creating the master data. And you see, now if you go back one, this is a master data that you're assigning some config data on it. That field status group is controlling how you enter data on this transaction, how you enter data. So you're saying, okay, the business says they want to trap. You could say, hey man, I want to keep track of the uh, uh, you know additional information on this particular account. All those fields that are in that group, in that field status group, there's 100 of them. You get to turn it on. Required,
Mm-hmm.
suppressed, or
Mhm.
optional.
Mm-hmm.
And you're actually controlling how the data gets on the record, so you can report on it. So uh, how you get on the record and how you get it off. And then by you establish consistency. So if you have this whole group, they all have to go on that record the same way. You establish a flat consistency on that account. You can't get past the control. You make something optional, then you're saying, hey, they can put it on and top put it on. If you make it required, you're going to force the user to have to enter something on it. So but when you put the information, then you can report on the backside so that the user can use it. So this is master data. Okay. This here is still creating more. This is just another tab in the master data that you're creating. Master data. This is this is document splitting, but it is saying when transactions are entered, how are you going to split the record so that you can, it's for reporting. It's for the how to get data out. So this is the config point, trying to make sure you cap so you can get data off of it, like a reporting. This is getting data off. Document splitting for document splitting sake is only for reporting purpose. So this is getting data off. The purpose of it. Mhm. And then this here, where you went through the passes of the document splitting. So here is classifying document splitting, which is saying uh, when you split the record, this is the kind of thing you're going to split it on. You're going to split this cash account. These cash accounts are going to get split this certain way. These revenue accounts are going to get split a certain way. But you can see all the config points in here. It um, how many? It's a lot of config points in it, but the value is small. Because the reason I'm saying is the reason not the value is not small. I'm not putting it down. It's because it's really a useful tool. We set it up. We set it up once, and we can. Sometimes someone wants a new account, and they put a new account, and they want it to have certain things on it, but the document split conflicts with it. Then you have to come in and adjust the document splitting, or make the account conform to the document splitting. But once you set it up, it's like, the users never see it. They don't even know it's there. They don't know how to use it. You know what I mean? And it's not, it's kind of invisible to them. And they never see it. They never know it, never talk about it, except some really sophisticated users. They're really,
I want to be.
yeah.
I want to be a.
Yeah.
Where
Yeah.
Rich at? Go ahead. What's this?
Yeah. Yeah. Some very sophisticated users will understand what document because um, it's so when you look at a revenue account, when you book to the revenue, a ledger, you book revenue. Say if you book revenue, and here's a lot of attributes you want on the revenue line. You want the amount, the quantity, the dollars, the currency, the customer, the material, the brand, the categories. You want all the different attributes that help you manage the business. So if you can get 100 attributes on one revenue line, you want the dollar amount, you want the rate, you want the customer, the product, the brand, the category, the group, the region, the city, the state. You want as much as you want. So here is that revenue line. It has all of these different attributes on there, right? Then you say, okay, well, you sold 10 products. You had 10 products, 10 different customers, 10 different materials, 10 different regions, 10 different. So you want that data on the revenue line. Why? So you can analyze it, right? Now, when you post the offset to it, you just hit receivables. I only need the receipt. I just want the cash, man. Just give me the cash. You need the customer, the amount they owe, the due they owe. It has a little bit less information than that revenue line. Right? Question? Right. So if you have one sale, got 10 lines on it, 20 different attributes on it, and you got that balance sheet receivable. So each one of these $100, you got $1,000 here. Boom. You got 100, 100, 100, 100, 100, 100, 100. So you got all the different kinds of attributes there, the characteristics there, and then you just got one line on the balance sheet. You only really some people are fine with just having one line on the balance sheet because um, um, I'm going to get paid from the whole cash for all the different products. If I want to see what I sold, how I sell it, um, then that's fine. I can go and get what I sold and what time I sold it, what region I'm selling it in, what customers I'm selling it in, what products are they buying, how often they're buying it. I can look at my revenue to make that determination. But if I want that AR, which is going to be short term, it's going to see that revenue is for all year. Yeah, because your P&L is like how much you sold for the year or for the month. It's like a time period. But this AR is going to have a due date. It's going to sit out here for 30 days terms. Those kind of things. The question is, do the customer want that same breakout on the balance sheet? Because I hit the P&L with the revenue, and then I hit the balance sheet with the AR on what the customer owed me. Do you want me to also take those 10 lines and split that balance sheet up in 10 different sections? Less customers want that. Less customers really, yeah.
So the P&L
Mhm.
is always split at greater detail,
Yes.
and then that detail can then be through document splitting. It can be expanded into the
Balance sheet.
balance sheet.
Yeah. So then you can get. So I got 10 because you like 10 different products on the sale. You sold 10 portables. I sold them a red bike, a motorcycle, a car, a plane. Different all these different characteristics, and you can have this guy was in this northwest and he was in the southwest and the region that they're buying, how often they're buying, is it weather, so you can start saying is it weather conditions or whatever. So you can from a market. But when you hit the AR, boom, you just want one line of the AR. Unless you want to understand your AR. So when you look at your balance sheet, you say, you can always have it by customer because you're hitting the AR by customer. Yeah. But customer by product, by region, that's by brand, by category, that's not necessarily a lot of companies don't ask for that. But if you say, oh, you want it, then you want Dr. Spinning. If you want that, then you want to make sure. And sometimes company will they don't know they want it day one. They might realize day three. So that's why you have to position them to. It's already doing the splitting so that it'll position them to have it in 5 years. Because when they recognize, I can get that too, then it's hard to get it after the fact. You gotta start tracking it ahead. So that's why you would know it. So you set it up. It's come prepackaged, already set up with document splitting, and you're just trying to maintain what they have given you with the document splitting to go forward, right? And if there's any unique document, but it's gonna already have document splitting when it comes in the package. When they take the package up, you don't have to do any program. You just say, okay, this is how it's being maintained. And and when it's explained to a customer, if he wants some more added, then you add more. Otherwise, you say, okay, we're going to keep what it's got so that when the customer realizes 5 years down the road, 10 years down the road that they want something, it's already in place for them to start tracking. But it's really like if you want your balance sheet and a lot of minutia on your balance sheet, than your P&L. But your P&L is kind of using your Europeans do a little bit different, but American financials is performance driven, which is your your revenue, your profit, your margin, your revenue, your profit, your margin, and you use that to analyze how well you're doing. With your profitability. You can if you get all that stuff on the revenue, then you got enough to do your analytics. What are you doing? Because you're trying to sell more, right? Um, Now, if you look at the balance sheet, it's just that a European has a different flavor. They're more balance sheet focused than these Americans. We're more P&L focused. But uh, financially, they're intertwined. We call the interpolation between the balance sheet and the income statement. They're really interpolate. You remember when you hit the revenue, you hit a accounts receivable. You hit the expense, you hit accounts payable. And so the changes in the balance sheet, the changes in your so you can look at your balance sheet and see the change in your balance sheet really represents the change in your P&L. Or the P&L, the change in your P&L really represent the assets and liability positions that you have. So your P&L is a summary for the year of the change that occurred in your balances in your balance sheet and vice versa. It really reflects your change in assets and liabilities. Your P&L is represents the change in your assets and liabilities. That makes sense. So they're really so you can say, because for example, you hit revenue, you increase AR. And so the change occur when you hit fixed assets, you're going to hit cash to pay for it. But then the depreciation is going to hit the P&L, and you're going to hit the P&L. So it's they're interrelated. It- They're interrelated, and the changes in one affect the changes in another. Uh, so some companies are more balance sheet focused, and some companies are more P&L focused. But most of us are P&L focused, right? I want to look at that dollar, that revenue, is it loss or gain, right? So you hardly see, you do see some companies use, I want the details on the balance sheet as well, right? So you say, okay, you take the cash and you take the AR, and can you break it out by the customers and the products and the reasons that made up that balance, right? That is a useful information. Yeah, to some, it depends on what kind of analysis. Say, my assets, my AR, if I look at my AR balance at any given time, most of my customers are from the northwest, northeast. You know what I mean? So if I'm going to talk about advertising dollars, I might want to put more, or I need to expand. These customers are already saturated. Then I need to expand in the southwest, different regions, because I can increase myself there and I'll grow, increasing myself. You know what I mean? But you can also probably get that same information from the P&L. Now, I spent a lot of time on it because there's a lot of config points in it, but that's all it's really doing. It's saying, do you really want, no, on the balance sheet. Now, there's a section of the balance sheet when we say, what's working capital? What's the term? So on accounts, you don't necessarily need to know those terms. What's working capital? What's working capital? It's just that unless you had some financial exposure or an accountant. But an FICO consultant doesn't necessarily know what the working capital. You ask the business, whether the business will come back and say, well, I really want my working capital accounts like this. My working capital accounts like this. And so, okay. But so I know what the working capital accounts are. Working capital accounts are, there's certain balance sheet accounts that we call working capital. What does that mean? They really is the main contributors to the revenue. the main contributors to the revenue. So, which is accounts receivable, inventory, accounts payable, and those kind of things. Those are the working capital balance sheet accounts. It's the ones that really work. Um, I guess you could, and they're kind of a short term in nature. You know what I mean? But a prepayment is not a working capital account. A working cash is not necessarily working, but it's the AR inventory. Those are the ones that you need to turn. You want inventory you got to sell the inventory. You got customers AR. You got payables. Those are the ones that you're turning all the time. Those are the ones that's working really. AR, inventory, AP. It's moving. Prepayments, long-term loans, long-term debt. Some of those things are not they don't turn all the time. You know what I mean? So when you say work, so some will like to have their working capital accounts more refined because those are, and it's just a certain section of the balance sheet that always turning. Inventory is always turning. So it's classified as a working account, working capital. And capital is another term. Here's your assets. In terms of your capital. Here's your debt. It's just another term for balance sheet. So that's all that. Now there are a few accountants who say, yeah, I want a little bit using a little sophistication. Say, hey, I got working capital. I want to find out a little bit more details. So let me get, because my analyst, my sales team or whoever, they want a little bit more information on the working capital. How many turns it's taking? How many turns inventory? Inventory is turning, 4 times a year or something. You know what I mean? And how's it? Which ones are turning? What's the? How long this guy been sitting in inventory? He's never turning. This section is never turning. The inventory turns. You have to buy this group of inventory 4 times a year. You went through it 20 times or something. You know what I mean? You replaced it 20 times. Some inventory you can't replace it 2 times. It's not working pretty hard. So, but so it's really aimed at a reporting. Once you set it up, it's done. It's stopped. I would probably over a year on average on an annual basis, if I were to set something up for a company on the average year, 5 hours at most I could use on this at most, for a whole year. If I were to deal with this, it would be probably 5 hours of time after I initially set it up. Unless a customer says, hey, I'm really into it a lot, then it will be a little bit more time. But from over my many years, that's been about the average amount of time I put in it. Okay? But it's been very useful.
Yes,
It's very useful to know.
Yes.
So here. So now, and this is already, it's just a lot more about it, but you can see the value of it. But you're still in setting up the master data. So when you set up the configuration data. So when the transactions come in, so you good with the document splitting.
Yes.
Yeah. So when the transactions come in, you're forcing it to split so that the other side will get to it.
Mm-hmm.
So this is all, and you want the split just by certain categories.
Mm-hmm.
This is all it's trying to say. Now document type, yeah, same thing.
Mm-hmm.
Same thing. Same thing. You see all the information,
Mm-hmm.
um, and now that is about all. I'm talking about document splitting for the next 2 years. That's more time I've talked about document splitting for the next for 2 years. Which is, but I know it, and it depends on the customer, the client, how much I will talk about. But sometimes it really it's but when it fails, it fails. It failed bad, right? It can't. Nobody can post. It won't post.
Mm.
It can't post. And if you create a new account, it doesn't conform to the documenting rules. It'll let you know real quick.
Yeah.
It lets you know real quick, huh?
It was telling me like if you create a new general ledger account, you gotta assign it to the document splitting
Yeah.
item category.
Item category. Yep.
Or a new document type. If you create a new document type, you have to assign it a business transaction.
Absolutely. And if it,
Yeah.
that's right. Or it'll fit. And you when you sometimes it has ranges that it automatically fits within those ranges. And so those are in the range. You saw those ranges that we had. So it fits in those ranges. So you have a when you think about it, when you see it fits in those ranges. But when someone creates a new ledger and it falls outside the range and it fails, you got to know. In the and the error message says document splitting.
Mm.
It says I got a document splitting file.
Mm.
So you can take it right to
Yeah.
the error message is document splitting. Document splitting is found.
Mm.
And then you'll be able to say, okay, this is where there's something wrong with you. Oh, you just new ledger. It's a new ledger or new doc type or something that was new. It doesn't fail once just on GP. It was you create a new account or something like that. But when it fails bad. It doesn't. You can't go forward.
I'm thinking in my head now, okay, if I want to stop it from failing, I can go into controlling in for the for the chart of accounts, and I can block that chart of account. I can click that block, and it'll prevent creating a general ledger account.
Yes. Absolutely. Control. Yeah, absolutely. So you would have one manager who's managing that. Okay, I got this chart. Nobody else can create a chart but me, right? And that would be yeah. I ain't gonna let five people.
And he's gonna know. Okay,
Yeah,
if I
he's
do
gonna.
create a new,
That's right.
then I gotta also create the business transaction variant and
All that
sign
kind of
the.
thing. That's right. That's right. And sometimes now, uh, I would say 9 out of 10 people who create the chart don't even know what a doctor is. 9 out of 10.
9 out of 10.
9 out of 10. So 9 out of 10 because the ranges are going to fall right into place when they create it. If you go back, you see these number ranges. So this number range is going to automatically. You have no gaps in there. If there's no gaps, then nothing's going to fall out. So you're going to still stay within that range. It's going to automatically hit there. If you have gaps in there, then you got yourself a problem. Because if someone can create something within here, like a 42, you know what I mean?
Mm-hmm.
Boom, it's not a sign.
Mm-hmm.
There's a gap. So you can't have any gaps in there. And everything, the whole number range from the top has to be filled in so that it'll automatically get populated. But if, but if you got a gap in there, it's gonna hit you. Somebody created one 11,
Mm-hmm.
and oh, I got no place. And this has gaps in it.
Mm-hmm.
You can see it. And if somebody creates an account within that gap, it's unassigned. So you got to force it that it has no gaps. You know, uh, why would they show this example? hmm Yeah, and they could have forced it that you can't create. You know, these are individuals, but from 70 to 80, what if someone create a number at 71? You know what I mean? You have to stop that. But that's how you schedule it. So that the range automatically takes care of itself. So that, so that's why it becomes invisible to the user. When you create the account, even though you use 10 of them already, you create a new one. It's going to comply to those rules automatically. Uh-huh. And then so if they see it once, then they see it, and that was enough to see it. Now this is where most of the meat is at. This is where most you gotta know most of it, like we're trying to say, I'm just going to create this ledger, and I want as much automation to come hit the ledger as possible. Right. So if I were to, I want the guy on the dock to do the RF gun, hit the material, and they hit post goods issue with a button. Boom, hit post goods issue, and it automatically reports. So that's where, and you know, when you do the type of sales entry, is it automatically hits the counter. When you any movement, you can identify the type of activity that's going on in the company. You want to have it on. Now, then there's some things that are just manual, you know, like. But even though there's modules in the system that can handle it, like SAP has a treasury module for loans, so you can go and buy interest swaps, foreign exchange swaps, um, loans, installments, CDs, and it'll automatically post to the ledger. Now, if you don't implement that module, then you just manually record an entry to replicate what the loan postings would be, or like leasing. Leasing is a unique thing that we created those account determination rules so that it'll automatically hit the ledger for all the cash flows, the payments, and the leasing module. You want that module to hit it. But there's all kinds of modules that are coming from SAP that automatically hit the ledger because the ledger is the central. Uh, it represents what has happened financially. What's happened. So you got all these different modules. Come HR module, a sales module, a capital spending module, fixed asset module, lease module, loans, treasuries, MM, production, you know, and they're all coming through the ledger. And this is the integration points where it has the most value. You got to know the integration points that are coming from the different um, other different modules, and they're very similar in nature. So if you really know one, how it's really structured, it's transferable to the others. It's really transferable. So if you just get if you really understand how the postings on the sales side come through, you really know how to on the purchasing side. And then if you see how they're coming through with electronic bank statements come through for Cash App, you really know how to configure any one of them come through. Because that concept is used, maybe it's a little different language here and there, but it's still going to use overall the concept is still going to be the same. So now we're talking about postings. We talked about how to get data off, about how to create the master data, and how to record the transactions, both automated and manual. This is sort of an automated one, right? So here, this is I can say, okay, FBKP. That's one way. OKB9. But this is telling you all of the places where like automate. These are the tables where the automatic postings for the different places that it's coming from. You know what I mean? So if you got this is where the real meat. This is where you would get your. Nobody wants to post manually to the ledger. Nobody wants to post manually to the ledger. They want everything to be automatically coming to the ledger. Now, unfortunately, you can't do 100%. They got to do some entries that are that's coming through and hitting manually, like accruals, accrual adjustments, and clearing and things like that. That you use an automated clearing. They want the clearing to be automatic, right? So here, each one of these has a unique appeal. So you look at this transaction. So these are going to be talking about automating. They're going to have. Hey, so when you have a pricing procedure on the sales side, pricing procedure is going to look like a spreadsheet. Look at the spreadsheet. Row 1, row 10, row 20, row 30. I'm just going to say, okay, here's row 10 is the sale price. Row 20 is the cost. Row 30 is the net. Row 40 is some uh, extra charges, you know, 40 is taxes, and then you just say, okay, taxes. You would say taxes. Row 40 is taxes. Taxes is 3%, and you say 3% from go get this 3% of line 10. That's all. 10 is the sale price. The tax column is the tax one is 40, and it's 3%. 3% of line 10. It's just like a spreadsheet, just saying, hey, if you look at one, it's just a spreadsheet of rows and columns, and saying, okay, and if you want something to do, but what it has is it has conditions in it, like a pricing condition, like we saw on the purchase side. Sales side has the same condition: sales condition, cost condition, bad debt, accrual condition, uh, expense condition. It has a condition record. And so, in each one of those conditions, you can tell each condition, you give it an account key, and then you assign. So each condition, if it's a real condition and not a statistical, you're just doing it for tracking, or you use it to calculate. Like uh, add these two together and then multiply this one. It's a statistical condition. You're just using it as a statistical to calculate another real posting. So you put an account key on every condition, and then you assign the account key to the ledger. And it's just basically that simple. So you got a pricing procedure is going to have a bunch of conditions. It's going to look like a spreadsheet, but it's calculating the rules, and they're going to be embedded in their automatic postings. And that's the same concept on the payable side. Condition, account key, which is a three-digit key. Okay, you would say sale price. Then the system says ERP is the account key. There. Anytime there's a price, it's going to always have ERP assigned to it. If you always anything that has ERP assigned to it, it goes to revenue account. And you just say, okay, prices. The price is the condition. The account key is ERP, revenue, and here's the GL you send it to. And that is coming in the mapping. So anytime that condition is used, you want it to post here. The more conditions you have, the more account keys, the more refined you can put to the different ledgers. So if someone wants to have 20 different conditions, you can have 20 different account keys, and you can point to 20 different ledgers. And then it'll just point to 20 different ledgers. And that will be the assignment, of that. Now that account key, some may call it posting key, some will call it account key, some will call it a different naming. They will give it different mods will give it a different name, but the concept is still the same. A condition gets assigned the account key, posting rule, and you assign it to a general ledger. And these automatic tables represents what's in them. So if you drill into that table, it's going to say account key ledger combination goes to this ledger. And then each one of those has a different function for each. It's automated posting for different functions. So each one of those tables has different functions. So now, and so now, so this is now what's a special GL?
Special GL indicators. That's is listed on what is it? Like 5 or 6 of them.
Mm-hmm. Now, what's his main purpose?
It's an alternative. Don't use the regular GL. Use this one instead.
Yes.
Or that. What was it? Down, not down payment. Security deposit. Is that one of them?
Yeah.
Special GL indicator, security deposit. There's I got the list.
Oh, but they can be anything. They can be anything. But here, so they don't have to necessarily be. But what they're really used for is that when you have a customer, when you have a vendor, it's for subledgers accounts, customers and vendors.
Value dated bank transfer, is that one of them? Mm-hmm. Value dated bank transfer.
Yeah. But what is that? So it can be whatever the customer really wants. So you can create another 20 of them. Here is the what real main reason for this. When you have a customer, and you have to sign a ledger to the customer, right? You have to sign a ledger when you go and create a customer master. On the customer master, you have to sign the reconciliation ledger. Every customer has to have a reconciliation ledger assigned. What that means is that anytime you debit or credit the customer, it automatically records to the ledger that that customer belongs to. Like you would say, all the customer belongs to the accounts receivable account. So anytime you put a invoice or a payment onto that customer, it increases or decreases the accounts receivable account because the customer is the sub ledger to the accounts receivable ledger. So all customers are sub ledgers to the main ledger accounts receivable. You can have other domestic accounts receivable, international accounts receivable. If the customer's international, you can actually put customers to your different accounts of reconciliation accounts. So you can have 4 different reconciliation accounts, and you can divide. I want So when I see my receivables, I can say, here's all domestic, here's all international, or those accounts. So you see those 2, or here's the intercompany, and here's intercompany domestic, and here's intercompany foreign. You know what I mean? And then the customer that, based on their address or location, you can point them to receivable accounts. So customers are sub ledgers to the main ledger. Let's just take one. Accounts receivable. Right? That's traditional, right? So just this when you say an alternative account, like when you see the alternative accounts, you're saying, okay, don't go to when you hit the customer, don't go to the normal AR. Direct it to the alternative account. So normally I would go to this customer and I'll hit the customer and it's going to automatically go. If I don't, it's going to automatically go to the accounts receivable. But if I want this one customer master and I wanted to have this one customer master and he represented receivable, but he also represent prepayments. So I hit him for some prepayments. I hit him for some alternative ledgers. So I can have multiple ledgers. The customer can be a sub ledger to multiple ledgers. So not only he's a sub ledger to the accounts receivable, he can be a sub ledger to accounts payable, right? So or he can be a sub ledger to another account, like security deposit. Like so, for example, is one of the examples of it's a security deposit. So I got a section called AR. I got another section called security deposit. It's an asset because the security deposit is say, I'm going to get the money back when the time is over. I get my security deposit back. So I want, and it's for this customer. This customer has a security deposit. I got to get it in this customer. Is my accounts receivable, but it's the same customer, but he is represented in 2 different ledgers. You use the special geo indicator to say when you put the posting key, it says debit. You put the special geo indicator. You says, oh, don't go here normally. Go to this other guy. And you're just saying, okay, redirect the posting from its normal one, which is which is the one you assign to the master record. You say, instead of going to this normal accounts receivable, use the special geo indicator to say, this is a security deposit, and it's going to take it and redirect it to the security deposit. But now, when you look at the customer, you're going to see both ledgers. Look at the customer, you'll see both ledgers. The customer's in both ledgers because one has a special geo indicator and one doesn't. But both have a posting key 1. One has, but just so it just redirecting it to the alternative account. And you can do that with customers and vendors and ledgers. So you can do it with, so you're only the special geo that said, hey, don't go here. You're a special case. I want you to go to another ledger. And you use a special geo indicator now. You have to tell each special geo indicator, you have to assign it to the account. So it has to know, that's where you go to the config, you say, here's the alternative accounts for these special geo indicators. And you just redirecting it to the different ledgers. Okay, when somebody uses it, it's going to go to the special deposit bucket. It's going to go to the prepaid bucket. So for example, when you prepay a vendor, you normally prepay a vendor for that's an asset.
Yes, yes.
Yeah, because you prepaid him,
Excuse me.
and if they don't perform, you get the money back. So it's an asset. Like insurance, prepaid insurance is a asset. You paid a vendor. The vendor normally rests with the accounts payable on the liability side, right? In the 200,000 accounts payable account, you got all your vendors tied to it. But I want this vendor. He asked for a prepayment on some insurance. So the prepayment is for a year of prepaid insurance. That's an asset to you because if they didn't perform the service, you get to get it back because you prepaid in advance. And so each month, as the insurance is paid off, you get the expense each month of it to the P&L. But it remains the asset until it's used. So you can put prepayment insurance. So we have a special indicator that says don't go to the payable, hit the asset section. So a vendor can be both on the asset section in the prepayment and on the accounts payable section. Now, and of course, these posting keys is is controlling how you put data on the record. Because like a 40 or 50. A 40 is the general ledger posting, and the 50 is a debit, and then a credit is a credit general ledger posting. And it has 100 different options. You can acquire, suppressed in the posting keys, just like the special GL indicators. So you can have this is a O1 posting to a customer is an invoice, and you can say that invoice has certain characteristics on that thing. So it's still controlling how data is getting onto the record. You're just controlling how data is getting onto the record. And all these different fields, if you go into that table, it's going to tell you all the posting keys. And the posting key is only used by the master data. I mean, or when you got to have a posting key for everything going into the ledger. So all customers has a group of posting keys. It all starts with a 0, 1 through 19. And those are customer debits, all different kinds of customer debits. And then you can have 21, no, yeah, then 21 to 29 is going to be a different kind of, I think it's, customer credits. And then you have 31s to 30, will be vendor debits and vendor credits. You get 40 is general ledger debits and credits. Then you're going to have 70, which is fixed assets. 75, which is fixed assets debits and credits. Then you're going to go on down to material master debits. They're in the 80s, debits and credits for material ledger. But each one is going to have a set of, if you look at them, you see, the the number range, it says, okay, when you do an O1, it's always a customer invoice. When you do a 31, it's always a vendor memo, credit memo. You know what I mean? So actually, so when you and it's telling you how you should post to the customer vendor, how the transaction should get on the record, how the transaction should get into the ledger. And it really is a ledger concept. It would be a ledger. A ledger is how you get data onto the ledger and how you get data off the ledger is really the concept. Recording transactions, how to get things on the ledger, and recording is how you get things off the ledger. Report off the ledger, and then the posting key is how you control data getting onto the ledger, and posting keys and documents and how you get stuff on the ledger. And so now the config, this is config data that is controlling how the user use that data, interact with the master data. Now this is the meat. This is where knowing these things and how they're controlled. Like if you go into doc types, there are certain fields in each of the doc types. Each field on the doc type screen does something. So not just doing doc types, but it's each field in the doc type is controlling the entry. Each field on the posting key controls the entry, and you knowing which fields controls what. That's where the meat is at, or the meat is at, or especially how you control the entry. How you control the entry, how to automate posting, how you control the entry to get it automatically into the system. Um, Clearing procedure is how you control the clearing. When you go into those clearing procedures, so if you look at those, if you go back, this is the table that has them, right? Okay, so this automatic posting config. If you were to do which every one of these is doing, it's really using the account key. So if these are the account, these are, when it says transaction, these are the account keys. So this account key is going to be tied to some kind of condition, and they're going to ask you to put when you got this checked, there's an account behind it, there's a ledger behind it, and it's going to say, do you want the debit to go someplace than the credit? If you yeah, see here. So it's taking the account key and then it's evaluation, but you're giving the debit and credit. You can see, so these like are the account keys. And let me just from this is material master. This section here is called valuation. This valuation section is so when you one of the first rules you have to define is how you're going to evaluate inventory. How you're going to value inventory. It gives you two methods of doing and how you evaluate inventory at the company code level or at the plant level. Okay. So that's why they give the term valuation, because it can be either one. They didn't call it plant. They didn't call it company. They call it valuation because it could be at the company level or at the plant level. So what does that mean? You got inventory for a company, inventory. You have a plant. Do you have multiple plants? So you got two plants for the company. Plant A, plant B, one's in Seattle, one's in New York. The cost structure in Seattle is different than the cost structure in New York. So you typically, most of the time, if you got a one-dimensional company, you're gonna have one plant, and you can probably make it. But the valuation is going to be at the plant level, because at the lowest level. So because the cost structure at a plant can be different. You want the cost of this plant to represent the cost of that plant, and the cost of this plant to represent the cost. But if I were to evaluate at the company code level, then they both have to share the same cost, but the structure could be different. You could be paying $5 an hour for labor in Seattle and $15 an hour for labor in New York, and so the prices will be $15 higher. You know what I mean? So the inventory that is sold, the cost of goods sold out of New York is going to be higher than the cost of goods sold out of Seattle. But if you combine them, then you're punishing one and burdening one and giving relief to the other. If you combine them and made it $10, so $10 is the cost because you combine Seattle and you combine New York into one consolidated cost of goods sold. But what you really want is you want to make sure New York has its cost structure and gets evaluated appropriately, and you don't burden Seattle because it has a lower cost structure. and the margins for his sales could be, higher compared to. So you want to, so you would shift more activity there because the cost structure is better. Um, so valuation means how you value it. You didn't think with two choices: company level, plant level. 99% of the time, plant level. You want the value at the lowest plant level, and so on and so forth. Now, so you can see when it's blank, it's universal. All plants is applicable. Then that's only for that one plant or the value. Now I can tie multiple plants to that one valuation. So if I can create this value, it's called a valuation group. So I put the valuation group. I can say every plant has its own valuation group. I can say each plant has its own valuation group. Or I can say all plants has the same valuation. This is only pointing to the ledgers. So I can maintain one group. All plants can have the same accounting rules. All plants have the same account. So I don't have to maintain an accounting rule for each plant. Or I can give the East Coast a different accounting rule that says all plants on the East Coast. I can go to the East Coast group. All accounts, all the plants on. I can go to the West Coast group, and then I can give them the West Coast group a different accounting rules. But typically, you would give them sign all companies to the same evaluation group. This is all. If you open it up, it says evaluation group, and the plants are assigned to this evaluation group, and so that means that all the potions are going to be treated the same for each one of them. And you can see how the so now, okay, so then you're basically saying now what kind of inventory you have. That's different. You have raw material, you have packaging materials, you can have chemicals, you can have powders, you can have whatever. You know what I mean? Uh, however you want to, how your inventory is broken out: raw, whip, finished goods, packaging. However your inventory is characterized, you just have these groups here. These are just saying this is finished goods, this is raw materials, this is trading goods, this is raw. So these are just so every time you create a material master, you have to give it one of those groups. So if it's a car, let's say if it's a fender, you give it a raw. So all fender. Let's say you got a motor, you're doing you're doing auto parts or something. All motors are going to be this guy. All tires are going to be that guy. So that now they're going to be treated the same. All tires, but you got to put it on the master record. You got to put the account key, that key, just like a condition. So it's like a condition. Like if you use a sales order, the master record. So it's going to follow that master record everywhere it goes. So you will say this is raw material. It's a 3,000. So every raw material, whenever somebody creates a raw material on the accounting view, you have to give it a raw material grouping. And so all raw materials are going to take this accounting. And then these are all the account keys. These are what we're talking about, the account keys. So this is like, okay, so this is just describing the type of activity. Like if it's a production order, it's a sales order, it's a goods receipt, it's a goods issue, and then each one. Then so this is saying if it's a goods issue and it's this type of material, then use that ledger. If it's a goods issue and it's that material, then use that ledger. You know that this is where the meat's at. So, but once you set it up, because how do you make that happen? The users don't see, they don't know how to do this piece. How to create the automatic postings so that anytime this movement in the inventory occur, you already got it mapped. Nobody has to post. It's usually tracing movements. 101, 102, 601, 602, 101. These are trailing the inventory movements. And this is mapping every one of them. Now, there's a cheat sheet for every one of these keys. So it says, oh, you know, BS. That's it's a this is what this movement does. This is what these are SAP delivered keys. And you can have, so here's a cheat sheet for all these movements. And this one here's for production orders. This one here's for sales orders. This is here for, you know what I mean? When sales orders are increased, there's one when sales orders are decreased. And then you would have, this is where the integration points between material management, production is right in this section. And you'll see GBB and all that. You know, start seeing them. So the GBB is at a higher level. It's one level higher. There's a bunch of other ones at the same level of GBB. You know, see, GBB is just only one. This is only talking about GBB, but there's another 20. So you just hit GBB, but here's all these other ones. GBB is the offset to the inventory posting. So you can see the offset to the inventory posting. So offset to the inventory posting is all these other sale. When you offset inventory, you're either going to have a sale, you're going to have a production order, you're going to have a move, you're going to have an increase in inventory, a decrease in inventory. And you do it in all kinds of ways. So that's just GBB. You got all these freight. You got freight costs. You I hit that? Is that this is a touchscreen?
No, it's not.
Okay. So if you were doing consignment payables, you'd be in that guy. If you're doing prepayments, you could be in that guy. If you're doing freight provisions, you could be in that guy. Customs, if you have customs, you're doing stuff for customs, you have that key assigned to purchase orders. You have this account key on a condition in the purchase orders for customs, and you assign that key. Back in there, when you drill into that, it's going to be asking for a ledger, just like that GBB is asking for a ledger, right? And then you assign that to a condition, and so on and so forth. But you can see all the different kinds you can have. Exchange rate differences. If you have, this is where it's going to go. External activity. If you have external activity, you assign that condition, that account key to the condition for it. You will put a GL behind that. That concept is everywhere. And that's where the most bang for the buck is at, understanding these tables. And sales distribution one, look, you've probably seen the one on sale. This is inventory. The one right here is inventory because this is that group. But there's other, and then,
Yeah, it made the point that FBKP had most of the automatic account determination, but not for sales.
not for sale. Not for sale. It had quite a bit. And it doesn't have the lease ones. It doesn't have the bank statement ones. It doesn't have so each one of these models have their own. This is mostly for inventory, which is a nice chunk of sales and inventory. Nice chunk. A lot of people don't implement lease modules or fixed asset has its own. You look at the fixed asset has its own tables, not this guy, but it has the same concept.
Yes. Okay.
That it'll tell you a place where to put the GL at and the fixed asset thing. But yes, and then this is same. So you notice how you could. This is a variant. So you could have one variant, 1,000. And then the next screen is that you can put all the just to 1,000. So right here. So I didn't see it. Post period variant per company. I didn't see. Yeah, here it is. So notice that I can have all of these go to 1,000. What did that mean? if I had all these companies assigned to 1,000, only one.
It's going to be one, you're opening and closing the posting period. You change that one posting period variant. That's the posting period
For all of them.
All of them.
They close and open at
Anything
the same
outside
time.
of that, it's closed.
It's
Everything
closed.
inside of that is open.
That's right. That's
Yeah.
right. So you can close them. So here's the saying, I want to close all these guys separately. But if you want to close them all together, then you would assign them all the same close. Then person would say, okay, I can close them all at the same time.
Mm-hmm.
Right?
Right.
More efficiently. You know. And this is where you would open and close them. Now, why do you have two of them? So this is the period 2, period 1, period 1. So it's got 1 through 10, 1 through 12, and this one has 13 through 16. And it can be, this thing is one of the most confusing screens because you can do it so many different ways. I set it up and said this way as well, but I can have 1 through 12 and then 1 through 12 over here. 1 through 12 over here and then 1 through 12 over there. Same exact two. 1 through 12, 1 through 12. But this one here has 1 through 12 for normal counting periods. And then you can have special periods, 13 through 16, like 4 extra periods, 13, 14, 15, 16, for audit adjustments. Okay. So when you post an audit come in and say, hey, I don't want you to change it but in period 13, review month 13, make an adjustment for an error that occurred at B10 over here. But so I'm going to make sure that when I look at 13, 14, 15 adjustments, they're all considered audit adjustments, so to speak. But normally, so when you report on them, it looks like it's in the same 12 periods, but they're just called special periods. And the only time I see people using this for adjustments, audit adjustments, where you've made a mistake, you don't want to change this is closed. He's closed normally. You just want the adjustments to show up to be tracked and separately. Now, a better use of it is you have 1 through 12 here and 1 through 12 over here. And you can close 1 through 12. Or you can have 1 through 16 and 1 through 16. And then when whoever controls this table controls the closing, basically.
So if they're both 1 through 12, how do you distinguish between the two?
Okay, so here is absolutely very good question. Very good question. Now there is this authorization group right here. See, this field here is blank. It's really called authorization group. And what it means is that if you put an authorization group, you can assign users to the authorization group. So
it's closed for y'all.
It's closed for me.
Open for you.
Yeah. So the authorization group, you say authorization group 2. And then you give all these guys that it's an authorization group 2, they'll be assigned here. And then authorization group 1 will be over here, meaning that you can close the ledger for everybody non-accountants. And then you can keep it open for all the accountants. So you can say, okay, MM, SD, all those OTC, I'm going to close it off for all of you guys. And then I'm going to leave it open for the accountant to do accounting adjustments. Because these guys booked this thing, it was so bad. It was an error, but the system errored it. But I don't want them to open it back up because if I open it up, something else could sneak in. So I keep it closed and I make an adjustment.
So it'd be something like, let's say these are both 1 through 12. You got 1 through 12 here, and we got 1 through 12 here, right? But we want to close this period, so now it'll be 2 through 12.
2 through 12.
So it's closed for them, but it would still be 1 through 12 here.
Absolutely.
With the authorization.
Correct.
Open for them.
That's right. Open for them. And then you will close these guys out, and they can't do anything in period 1 anymore. But 1 is still open over here, and then they can still, and then whoever assigns to that authorization group, and it could be inverse, or so this table could be the authorization, who's excluded. Anybody in here, and then you would close it. You say that it relates to these guys, and then or these it could relate to these guys. It sort of matter.
Okay.
But So now because what's happening is that, so what's happening is like sales are coming through and they're putting dates on those sales orders and invoices. And those dates could be backdating. You know, like the goods issue was February 28th, and here it is March 11th. And the date had, and it's gonna, if the system is automatic, it's gonna try to book it to February 28th. If it comes through, it's because it's automated, but a date is on there, and somebody left the date on there was February 28th. If February 28th is open, it's gonna slide on through. So you close it, and so what if another one you want to let through? You know what I mean? So you can, but if you open it back up, all those things are going to come through. You won't, you can't control it. So you want to be able to close it and control it, and only allow things that you want to come. And so that's why. So automatic postings are going to be coming. They're going to be coming fast, especially if you're a multi big company. There's thousands and thousands of transactions that's going to be all over you, and this is the only way to kind of keep track of them. But so you can see here how we just add a little bit color to it. So okay, that little column, and it could be used to be. You can also use it to not have authorization. Just not having the field populated. So you have to create a little group called, you know, group 1, group 2, and then you assign users to the group. And security team. So you say, create me a group, group 101, and then put these users in that group. And then you put it there, right? Okay. And you'll work with the security team to get the group and put the users in the group and so on. And that's how you control it. But yeah, so it doesn't. And this thing is as SAP can't even explain it well. No book can explain it well. It's just very hard. It's very hard to explain that. You know what we just talked. Because look how it could be different. It could be different.
Yes.
It could be 13 to 12. It could be another group. It could be. I can use a different security authorization for another. Or I can make use this one, and then make this one the authorization. So it's very flexible, but yet it's got two different ways of using it. You know, without authorization, with authorization, special periods, without special periods, and they look the same. And unfortunately, they look the same. You know. All right. So you can see, but and now we were just talking about the transaction, and then this intercompany posting. This guy, I am the opinion when I use this transaction, I usually like to give it right here. There are two different companies doing business with each other. I like to give it a subledger. So this is a receivable, and this is a payable, because it says receivable here. I like to use customers and vendors here, because that's how I say. Now, if I look at this, they're using ledgers. How do I know that? How do I know that? How do I know that these are not customers and vendors? These are general.
Account number.
I can have a customer number with a 1, 2, 3, 0, 0, 0. I can have a customer number. It's because the posting keys. These are general ledger posting. Everyone. These are the famous 40 and 50. There's only these two uses ledgers. 40 for debit and credit. There's no other. They don't use them anywhere else. 40 and 50 is general ledger debit, general ledger credit. So that means that the next thing has to be here is a ledger. But if I were to use an 01 and a 31, this is there has to be a customer, and this has to be a vendor. So that means that that means that I have to have a ledger, almost a ledger for each combination. You know what I mean? But if I have a customer, I can put these two customers and these two combinations, I can have this vendor combination. Yeah. And then you can put a trading partner in the customer vendor account. And you really, when it's intercompany, the next important thing is called a trading.
Mm. Yes, it establishes a sender receiver relationship.
Yes, yes.
For the it can be used too for the uh, documents.
Yeah, you could use it for document, but it's for consolidation.
Yeah.
So, so if you have two relationships with two companies, right? And so you have accounts receivable and accounts payable. On this company, you have a receivable with company A, and company A, you have a receivable with company B. So he has a payable and he has a receivable. Right? He has a payable and he has a receivable. This guy can have receivables against company A, company 2, company B, company C, company D, company G, and all is the receivables, right? Because they got 5 different companies, A, B, C, D, A, B, C, and he could be, this is B, so he's got a relationship with B, C, D, A, and it's all intercompany receivable, intercompany receivable. So if you got one account called intercompany receivable, you need the trading partner to know whose your relationship is with. So it's intercompany receivable, the ledger, plus the trading partner, or it's with B, it's with C. It's with, so what happened? And then this guy over here with B, oh, it's with A, and here's with C, and here's with D. So the trading partner, if you consolidate these companies together at the top, and you create a balance sheet of what they all combine, you have to eliminate. You have to eliminate the receivables and payables between the two.
For group reporting?
Huh? Yeah, for group reporting. You have to eliminate, and the trading partner helps you do that, right? So either that you're going to put the trading partner on the ledger, and you can only use, so you're only going to have one trading partner per ledger. So that means you have to have a ledger for every different partner, or you just have a customer. You don't have to crowd up your ledger with all these different intercompany accounts. You can just have one intercompany account with multiple customers and vendors, and then you can assign the customer and vendors to the one account. But you can put the trading partner on them, so it'll track you with it. As opposed, because if you have to put a trading partner on that ledger. And then that if you put a trading partner on that ledger, you can only have that ledger dedicated to one company. So you have 100 companies, you got to have 100 ledgers just to represent all the different company combinations. But you can have one ledger, and multiple customers can be tied to that one ledger. And then you can just have a unique number range for them, and you can put the trading partner on that customer, and it's still going to act the same. And so when you consolidate, you got to eliminate those receivable payable company and revenue expense combination. So if you sold something to a sister company and they got the cost and you got the revenue, you have to eliminate that as well. You have to eliminate the accounts payable, accounts receivable, and the revenue and cost, so that you don't double book. Because if you double book, because you're looking at, you're just saying, I'm to the world, I'm looking out from the world, says, world, I'm just one company. But if you say, well, I'm just one company, but I'm showing you double revenue, then that's deceitful.
Yes.
Mm-hmm. So GAAP says, don't do that. But this representation is not a thoroughbred representation, if that makes sense. This is a more seasoned one will do a 01, a 31, a customer and a vendor, customer vendor, 31, because it's going to expand the chart. It's going to do certain things but it's just as easily accomplished using customer vendor, and then you can reuse them for every combination. No. Cool. So how you want to continue this?
Um,
Did you see recording all this?
yes, I'm recording. I'm recording it. It's
Oh my!
But this is brilliant. This is great. I think I'm gonna put this on YouTube. It'll give
So
me 1 million views.
yeah, so yeah, and then this guy is exchange rate differences. Let's just and then just give you accounts for gains and loss. Uh, Canada and U.S. is a big. They go into trade wars, right? Mexico and U.S. go through trade wars. Uh, I watch CNBC all the time. It's the business channel, and I see the currency exchange rates all the time. So I know the exchange rate for Canada and U.S. is $1.40 Canadian dollar to the dollar. So it's about 60 cents. So a dollar U.S. can buy $1.40 Canadian dollars. Mexico about 20 pesos to the dollar.
Okay.
So $1 you get 20 pesos at these times. A couple of months ago it was about 16, $17, 17 pesos.
Oh, that's a big fluctuation.
Yeah, so because of the volatility recently since the Trump administration, and the Canadian it was about 138. Now it's 140, 136, 137. Now it's 140. So the U.S. has more buying power in both of those situations, right? $1 as opposed to $1.36. It's $1.40. Yeah. Mexico is $20 as opposed to 16. 20 pesos as opposed to 16. But of course, they something costs $3 here. It costs 60 pesos. There's 60 pesos in Mexico. So it's the exchange rate. So it's exchange. So when you can have sales. SAP is multi-currency, multi-language. So it can be these transactions can be shown in Spanish. All these right here can be shown in Spanish. So you can do this turn. Okay. Okay. Thank you. Oh, thank you. At 9.
So, I'm sorry. I thought you closed at 10. Sorry. Thank you.
Right now. Thank you.
Shut it down. Thanks, Rod. Sorry to keep it so long.
So let me close that thought.
Thank you. Thank you, sir.
You got it?
Yeah.
Thank you so much. Sorry for the information. So, multi-language, multi-currency.
You can track 3, right?
Huh?
You can track 3 currencies.
You can track more, but you typically would do 3 simultaneously. But I can have just on a particular transaction, right? 3 on a transaction. Okay. But it can be pesos, it can be French francs, it can be any of them. It can be any of them, right? I can use all of them. So I can use German, Deutsch marks, Japanese, or any of them, right? For every transaction. I can use all of the currencies. But when it tracks, it's going to track the company code currency and the transaction currency and the group currency. Okay. So a company code currency is what country the company belongs to. But a company can be in Japan, transaction in US dollars. It could be a Japanese company having some transaction.
I would have left it. I would have left it if I didn't say it right there.
So if you're a Japanese company, you gonna keep your books in Japanese. Let's do Mexico. Pesos. You'll keep track of your company in pesos, right? Your Mexican company. Right?
Good. Wallet, key, phone. I think I'm good.
think so. Thank you.
I'm gonna keep track of your business then.